We will discuss some of the intricacies of dark pool trading, today as part of the production series being premiered by Innovative Techniques Production Company, a subsidiary of Innovative Tech. A dark pool is a type of financial trading venue that operates outside of public view, allowing buyers and sellers to execute trades without revealing their identities or the details of their transactions to the rest of the market. Dark pools are typically used by large institutional investors, such as mutual funds and hedge funds, to execute large trades without tipping off the market or affecting the price of the securities being traded. Dark pools are private exchanges where securities are traded anonymously, away from the public eye. While dark pools were initially created to facilitate large trades by institutional investors, they have faced criticism for a variety of reasons. One issue with dark pools is that they can potentially lead to market manipulation. Because trades in dark pools are not reported until after they have been executed, it is difficult for regulators to detect and prevent illegal activity, such as insider trading. In addition, the lack of transparency in dark pools can make it harder for individual investors to make informed decisions, as they do not have access to the same information as the traders participating in the dark pool. Another concern about dark pools is that they can contribute to market fragmentation. With more and more trading taking place in private exchanges, it can be harder for investors to get a complete picture of the market. This can make it more difficult to accurately price securities and can lead to increased volatility. In addition to these issues, there have been instances of misconduct by operators of dark pools. For example, in 2015, the operator of a dark pool called Barclays was fined by the Securities and Exchange Commission, SEC, for misleading investors about the nature of its dark pool. Dark pools are alternative trading systems, ATSs, that do not provide their best-priced orders for inclusion in the consolidated quotation data. They offer subscribers venues where anonymous orders interact away from the market, yet execute at prices no worse than the national best bid offer. In the U.S., there are over 50 dark pools, and the 19 of them for which data are available, from Rosenblatt Securities Incorporated, account for more than 14% of consolidated volume. In Europe, the 16 dark markets which report to Rosenblatt account for approximately 4.5% of volume, and in Canada they represent 2% of volume. The most active types of dark pools in the US, Europe, and Canada are bank/broker pools followed by independent/agency pools. These pools generally offer continuous execution and execute at prices derived from the NBBO. The independent/agency pools, like ITG-POSIT, are instead operated by agency brokers and offer periodic executions at the midpoint of the NBBO. In market maker pools, liquidity can only be provided by the manager of the pool. Consortium-sponsored pools are owned by several banks which already own their dark pool and use the consortium-sponsored pools as trading venues of last resort. Finally, exchange-based dark pools are owned by exchanges and offer continuous execution. The rising market share of dark trading recently prompted 3 major U.S. exchanges to publicly urge the Securities and Exchange Commission to place rules to curb dark pool trading. Exchange officials are concerned that dark pools divert volume away from lit venues, rather than attracting new order flow to the market. Overall, while dark pools can serve a useful purpose for certain types of trading, they also present a number of risks and challenges that need to be carefully managed. This video is produced by Innovative Techniques LLC.
Transparency issues which can lead to market manipulation and other forms of financial fraud. Additionally, lack of transparency can also impede the ability of regulatory authorities to effectively oversee and regulate financial markets. Some specific examples of transparency issues in market trading include lack of access to information. Some financial institutions may not disclose all of the information that investors need to fully understand the risks and potential returns of their investments. This can make it difficult for investors to make informed decisions about where to put their money. Hidden fees and conflicts of interest. Financial institutions may charge hidden fees, such as bid-ask spreads or transaction costs, that are not always clearly disclosed to investors. Conflicts of interest can also arise when financial institutions have an incentive to prioritize their own profits over the best interests of their clients. Opaque financial products. Some financial products, such as derivatives, can be complex and difficult for investors to fully understand. This lack of transparency can make it hard for investors to assess the risks and potential returns of these types of investments. Lack of regulatory oversight. Some financial markets may not have adequate regulatory oversight, which can make it easier for market manipulation and financial fraud to occur. Insider trading. Some market participants may have access to non-public information that gives them an unfair advantage in the market, which can lead to market manipulation and a lack of trust in the market. Regarding the lack of access to information as a transparency issue in market trading, some specific examples include limited financial disclosures. Some companies may not provide detailed financial information, such as balance sheets or cash flow statements, making it difficult for investors to fully understand the financial health of the company. Insider trading. Some market participants may have access to non-public information that gives them an unfair advantage in the market, which can lead to market manipulation and a lack of trust in the market. Lack of information on investment products. Some investment products may not provide enough information on their underlying assets, strategies, risks, and potential returns, making it hard for investors to fully understand the investment and make informed decisions. Insufficient reporting on fund performance. Some funds may not provide regular or detailed information on their performance, making it hard for investors to assess the performance of their investments. Limited transparency on fees and expenses. Some investment products may not provide clear information on the fees and expenses associated with the investment, which can make it difficult for investors to fully understand the potential returns on their investment. Regarding the lack of access to information as a transparency issue in market trading, specifically limited financial disclosures, some specific examples include limited information on revenue and expenses. Some companies may not provide detailed information on their revenue and expenses, making it difficult for investors to fully understand the company's financial performance. Limited information on cash flow. Some companies may not provide detailed information on their cash flow, making it difficult for investors to understand the company's liquidity and ability to pay its debts. Limited information on debt. Some companies may not provide detailed information on their debt, making it difficult for investors to understand the company's leverage. Limited information on executive compensation. Some companies may not provide detailed information on their executive compensation, making it difficult for investors to understand the pay structure of top managers. Limited information on risk factors. Some companies may not provide detailed information on their risk factors, making it difficult for investors to assess potential risks associated with the company. Limited information on governance. Some companies may not provide detailed information on their corporate governance practices, making it difficult for investors to assess the effectiveness of the company's internal controls and processes. Inaccurate or out-of-date financial statements. Companies may include inaccurate or out-of-date financial statements in filings, making it difficult for investors to accurately assess the company's financial health. Insufficient disclosure of related party transactions. Companies may not disclose all material related party transactions, making it difficult for investors to determine if any conflicts of interest exist. Limited shareholder rights. Some companies may provide limited shareholder rights, such as restrictions on voting rights or limited access to board meetings. This can make it difficult for shareholders to exercise their rights and hold management accountable.